Welcome to another episode of Financial Insights in Minutes, where we summarize the day's top financial news for you. Today's crucial topics include fears of recession, soaring national debt, and volatility in asset markets.
Right. With experts shedding light on liquidity trends and unemployment rates, we're in for an enlightening discussion.
Stick around for insights from various financial gurus and find out how these dynamics could impact your investments. Mark Moss emphasizes that the U.S. can't afford a recession and anticipates massive liquidity injections. Jeff Snyder warns of imminent unemployment spikes despite stable current indicators. Lynn Alden shares insights on the U.S. debt crisis and the urgent need for fiscal reforms. Craig Hemke discusses the alarming divergence in asset classes and market volatility. Nick Timiraos elaborates on the Federal Reserve's impending decisions amidst election pressures. Mott Capital outlines the critical importance of the upcoming job report for market predictions. Welcome to Kitco News. Today, we're diving into the economic storm, what's really brewing with inflation and asset prices. To help navigate these waters is the insightful Mark Moss, host of The Mark Moss Show. His insights on Bitcoin and macroeconomics are sure to enlighten.
Absolutely. Mark has been analyzing the shifting tides of the economy for years. Buckle up, viewers. This is going to be a wild ride.
Mark, what's the main thesis here? What's driving the current economic climate?
The core argument is that the U.S. simply can't afford a recession. Amid record deficits, the government will resort to printing more money. Instead of an impending crash, we may just see a continuation of inflation.
Let's break it down. What did Mark imply about the Federal Reserve's recent actions?
He notes that while the Fed is holding interest rates, a cut is likely if inflation shows improvement. This is crucial, as inflation trends dictate financial strategies.
And what about the staggering national debt?
Mark highlights that with the debt reaching beyond $35 trillion, the government simply can't function with reduced tax revenue during a recession. They're trapped.
Interesting perspective on asset ownership. What's the takeaway?
Mark argues that in a debt-based system, true ownership of assets is an illusion because value is tied to an inflating dollar, which creates an investment bubble.
What predictions did Mark make regarding future inflation?
He believes inflation will continue as the only option left is more money printing. This will keep living costs high and purchasing power in decline.
What about Bitcoin? How does it fit into this landscape?
There's a strong likelihood of Bitcoin being adopted as a strategic reserve asset by nations. This could radically shift its value due to increased adoption.
Wrapping this up, what's the key takeaway?
Mark emphasizes that as more liquidity pours into the economy, inflation will rise, pushing people toward Bitcoin. Understand your assets and the impact of monetary policy.
Welcome back to Eurodollar University. Today's riveting topic is unemployment about to hit the fan. Joining us as always is our seasoned expert Jeff Snyder, who knows more about Eurodollar markets than most know about their own bank statements.
That's right. Jeff uncovers the intricate patterns and cycles that have historically forecasted unemployment surges. So grab your life vests because the waters are about to get choppy.
So what's the crux of Jeff's message? Why should viewers be alarmed about unemployment right now?
The main point is that while unemployment seems stable, historical patterns tell a different story. Jeff argues we are on the brink, the calm before a storm, as laid-back economic indicators can precede sharp layoffs.
Now let's break down some of the critical stats Jeff highlighted. What are the market responses indicating?
Well, initial jobless claims hit 249,000, the highest number in quite a while. Coupled with a weak PMI signal, it's an alarm bell ringing loudly.
And what about the Federal Reserve? What's their role in all of this?
The Fed is trying to keep pace, but it seems markets are already sidelining them. As Jeff points out, speculative trading is anticipating several rate cuts due to worsening economic prospects.
Interesting. Tell us more about those historical patterns.
Every recession has shown that unemployment flirts with rising before dramatically spiking. Jeff emphasizes that initial signs are often confused with economic strength when in fact they're precursors to deeper recession troubles.
All right, let's look ahead. What predictions did Jeff make regarding the economy?
He fears that we're approaching that point of no return, where a rise in unemployment becomes inevitable as the economy officially moves into recession territory. Expect several more rate cuts in the coming months, too.
So, what wraps all of this up? What are the big takeaways from today's discussion?
Jeff concludes that although the unemployment rate appears stable at first glance, history demonstrates that we often face a more significant rise in unemployment down the line. Viewers should brace for turbulent waters ahead.
Any final thoughts for our viewers?
Absolutely. Stay informed and keep an eye out. Economic indicators are showing signs that, if ignored, could lead to some major employment crisis in the not-so-distant future.
Welcome back to David Lin's channel. Today, we're navigating the turbulent waters of U.S. debt, now over $35 trillion. Joining us again is Lyn Alden, founder of Lyn Alden Investment Strategy, a pro in macroeconomic trends and investment strategies.
Excited to dive in, Lyn's knowledge makes complex topics more digestible, and today we're unpacking what this massive debt means for investors and the economy.
What's the main thesis from Lyn's insights?
Essentially, we're facing a slow-motion fiscal crisis. Lyn believes the increasing debt without enough buyers poses a significant problem for the economy.
Let's break down some key points. First up, how significant is this national debt?
It's huge. The national debt just passed $35 trillion. As debt rises, concerns grow about who will ultimately buy this debt.
And what's the Fed's game plan?
The Fed's recent rate hikes mean higher federal interest expenditures, and they're treading carefully regarding future cuts.
Interesting. What does fiscal dominance mean for us?
It means that the annual fiscal deficits are larger than the amount of new bank loans, complicating the economic landscape.
What does Lyn foresee regarding inflation?
He predicts above-target inflation could become the norm if central banks intervene without adequate controls.
Any investment forecasts to keep an eye on?
Yes, if the U.S. economy softens, emerging markets and select resilient equities could see growth.
So, what are the takeaways from Lyn's discussion?
There's an urgent need for robust fiscal management as the national debt surges. The ramifications will require careful navigation in our investment strategies.
And what's the final advice for viewers?
Investors must stay informed and adaptable. Understanding these macroeconomic changes is vital for making sound investment decisions.
Welcome back to another episode. Today's voyage dives into the tumultuous waters of asset classes and their wild price swings.
Absolutely. Craig Hemke is here to break down the latest market chaos. With his deep expertise in financial market dynamics, he's navigating us through today's stormy seas.
So what's the core thesis here? What are the big waves shaping this market?
The main thesis is that we are witnessing extreme divergence and volatility in asset classes, leading to unpredictable price movements in stocks, bonds, and commodities.
Let's delve into key points. What happened with the market sell-off?
Traders witnessed a panic-induced sell-off, with stocks showing a sharp decline of 6%. This drop signals that fear is gripping the market.
What about the divergence in asset classes? It sounds intriguing.
Yes. While the stock market sinks, utilities and gold are seeing significant gains. Gold is even hitting new all-time highs, showcasing its appeal during turbulent times.
And what does Fibonacci say? Is it predicting more trouble?
Indeed. Projections suggest that the market could drop by nearly 3% from its previous close, indicating further trouble ahead.
Bonds seem to be a hot topic too. What's going on there?
Bonds are undergoing a bottoming formation, signaling increased interest despite the market's volatility. Traders are closely monitoring these moves.
So what about predictions? What does the future hold?
Further market declines are anticipated as more panic selling may occur, with the stock market under increasing pressure.
And what should traders do? Should they steer clear or find new strategies?
Defensive plays like gold and utilities may remain safe havens, while real estate stocks could see temporary relief as investors look for stability.
To wrap things up, what should traders take away from this analysis?
Traders need to adapt their strategies to navigate this turbulent market landscape and focus on safe haven assets to weather the storm.
Any final thoughts from Craig?
Emphasizing sound trading strategies is crucial in these volatile times to safeguard investments and capitalize on market opportunities.
Welcome to Blockworks Macro. The Federal Reserve is navigating treacherous waters as it approaches the 2024 election. Joining us today is Timiraos, Chief Economics Correspondent at The Wall Street Journal.
Exactly. Nick's insights into the Fed's recent actions and economic implications are invaluable. With his expertise, he helps us understand the link between monetary policy and the upcoming election.
What's the primary thesis from Nick's analysis?
The core thesis highlights that the Federal Reserve's signals point toward impending rate cuts, prepping their strategy while considering election pressures.
What's the scoop on the recent Fed meeting?
Market reactions indicate confidence in a rate cut for September. Powell's remarks were notably dovish, suggesting a responsive policy shift.
And how about the inflation indicators?
Inflation data recently indicate positive trends. However, labor market data shows initial signs of cooling, prompting cautious optimism.
What's Nick's take on political influences?
Political pressures during an election year heighten scrutiny on the Fed. Historical examples show prior political influences can sway decisions.
What predictions did Nick make?
Nick anticipates potential economic softness moving forward. The job market data will significantly influence whether rate cuts happen in September.
Any predictions from Nick about rate cuts?
Absolutely. The consensus is leaning towards September rate cuts. However, future reductions hinge heavily on upcoming economic data.
What other trends should we watch for?
Monitoring softening indicators will be crucial, as they could prompt the Fed to maintain more accommodating policies moving forward.
In conclusion, what are the biggest takeaways?
The Federal Reserve's challenge lies in balancing economic signals while avoiding political backlash. Their path forward will depend on how the data unfolds leading into the election.
What does Nick emphasize about Fed communication?
Nick highlights the necessity for the Fed to clearly communicate intentions in light of market expectations and upcoming elections to maintain credibility.
Welcome back to Mott Capital's Market Chronicles. Today we're navigating through the market's latest twists and turns, specifically focusing on tomorrow's crucial job report.
This job report is causing quite a stir, and not just because it could influence the markets. It's a pivotal point for understanding the broader economic landscape.
So, what's the crux of the upcoming report?
The main thesis suggests that the job report is not just another statistic. It could signal whether we're stepping towards a recession, especially with the S rule in play.
Let's break down the key points, starting with the job market outlook.
Exactly. Analysts expect 175,000 jobs to have been added, with the unemployment rate forecasted to remain steady at 4.1%.
And what about the notorious S rule?
The S rule. If the unemployment rate increases by over 0.5%, we could be looking at a recession alert based on historical patterns stretching back to 1960.
What can we expect in terms of market dynamics?
We might see a swift rotation from stocks back to bonds as the market reacts, especially if the numbers aren't favorable.
What predictions are floating around regarding tomorrow's report?
If the job numbers come in weak, we might see the Fed cutting rates, which could further increase credit spreads, particularly affecting smaller companies.
Any insights on how mega-cap stocks will react?
Definitely. There could be a loss in investor confidence, prompting a shift towards bonds, creating an interesting dynamic in the stock market.
To wrap it all up, what should viewers take away from today?
The market stands at a crucial inflection point, with tomorrow's job report possibly determining the financial landscape in the coming months. Everyone's ears should be perked up.
In today's analysis, Mark Moss argues liquidity is crucial to avoiding recession, while Jeff Snyder warns about inevitable unemployment spikes.
Lynn Alden raises alarms on national debt, pointing to a lack of buyers. Meanwhile, Craig Hemke discusses the volatility affecting asset classes.
Ultimately, our experts agree on the significant challenges ahead, but diverge on the timeline and nature of the economic downturn. Thanks for watching Financial Insights in Minutes for August 2nd, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.